This is on page 13. The page numbers are at the top right for this booklet. So yeah, this is actually a very good one that I want you to be aware of when it comes to finance, right? So you've got an individual that is basically, we're seeing the portfolio, right? There's that word again, the investment portfolio. That usually means that you have more than just one investment happening for yourself, okay? And in this case, you can tell that we're diversifying, right? Diversification. Marty, for now, you want to sit somewhere in the back there, one of those seats? So we're diversifying. Why do you want to diversify if I were to ask you that question? Think of, I don't want you to make this your answer, but think of, don't put all your eggs in one basket. That's what I want you to think of when it's diversification time. And some of the explanations for that would be to offset losses. So if you lose somewhere, right, your other investments will kind of keep you afloat. Got the booklet. We're good? And the bin. And the booklet. So nervous. Okay, anyways. You've got low risk mutual fund. I talked briefly about mutual fund on the very first video. Mutual fund is just when in companies, those are even insurance companies, they grab money from a bunch of people. Because let's face it, we don't all have like $200,000 sitting around, do we? Probably not. But in the world of investing, they won't invest $10. Like nobody, most of the time they don't want to just take your $10 and invest it. It's too annoying, right? So what they do is they grab 1,000 people and they all do like, I want to contribute $10, $15, $200. So they take that and they take those mutual funds and they invest it big time in the market, right? So they have like that purchasing power. They're like, I've got $1 million from all these individuals from all over the place. I'm going to invest it now. And so when you make that investment strategy, your advisor is going to ask you, what kind of risk are you willing to tolerate? I'm like a medium risk person. I'm not going to go all risk, like full risk, because I'm like, what if I lose money? But medium risk, medium to high risk maybe. So what they will do is they'll take that money that they're pooling and they'll be like, okay, we're going to invest some in the stock market. We're going to invest some in oil, in the oil sector. We're going to invest some in just commodities, right, like oil, gold, or assets like that all over the world. Some in real estate. You know, these big skyscrapers in different cities, that is owned by investment corporations, right? And so they take your money and invest it, and that grows over time. Okay, so that's basically why you want to diversify. So, and mutual funds do that as well in a sense. They don't put all your money just in one fund, okay? That was a big side note. Anyways, mutual fund, but that's a low risk, guaranteed investment certificate, and bonds. So we put in 2,000, 6,000, and 4,000, right? And it tells us that every single one of those investments gained. And here I want you to remember, it won't always be a gain. Sometimes there will be loss in a table like this. So just keep that in mind. So that means that we started with 2,000, we gained 100. So technically we have 2,100 now in the account, right? So this is like a future value. Okay, so we can add a column if you'd like. So you went from 6,000, you got $220. So now your investment is worth 6,220.
This English class, I have another school to come and give me a test, like a emotion test, something like that.
So you need to go do that?
Yes.
Okay, go ahead.
Okay.
This is 4,180 that you have at the end of your game, right? So this is something to keep in mind, that a table could have more than just those two pieces of information. In fact, just follow here my train of thought. This could have been a scenario where initial investment is 2,000, future value is 2,100. You would have had to do the math to say that we gained $100, right? So sometimes you just have to read these carefully. So we fill this in. What is the overall rate of return of Bruce's investment portfolio overall? So remember, rate of return is in general what you've gained, right? And that could be interest. That could be simply that the value of your investment went up, right? The market just went up, and so your shares are worth more, versus amount deposited. So you're comparing any gains to what you've put in, and you multiply that by 100. I know I gave you formulas on this, so this may be slightly different than the formulas, but it still works. Okay, so let's do the math here. How much have we gained? You can either just add it up here, or I'm just going to show you here. It's 100 plus 220 plus 180 divided by how much have we put in. According to this table, we've put in $2,000, $6,000, and $4,000. We're going to multiply that by 100 when we're done. This is $500 in interest earned. And this is $12,000 that we've deposited times 100. So we go 500 divided by 12,000 times 100. That's 4.17%. It's not the greatest, to be honest. It's very low. So this is what I'm going to tell you. Over your lifetime, you'll have different opportunities to invest. And I will show you the tools, how you can actually forecast, predict how much to expect in your account way down the road. And so if you're like, wait a minute, is this better? Is this 5-year investment better than this 10-year? What is it? At the end of the day, if you do your ROR and the percentage of, you do a bunch of calculations and you find the one that has the highest percentage, that is the best investment. Okay, guys? So everything else goes down the drain. You have to see, like, what is my rate of return? How much have I gotten back for every dollar that I put in? Okay? Okay, so that's your rate of return there. Do you think that Bruce's investment portfolio is appropriate for him at this stage of his life? Justify your answer, stating your assumptions. We got to go back to the question. We have to look at Bruce's age first and foremost. Before we make give him advice, we got to look at his age. He's only 24 years old. In my books, that's still young. Okay? You're still in the younger phase of your life. And he started when he was 20. What do you observe when you look at his risk in terms of his portfolio? Do we see any high risk investments there? No. It's like low risk mutual fund. GIC, you know it's low risk. Bonds are fairly safe as well. So they're all safe, all low risk. Okay? So what do you think? Is that appropriate for a young person to have everything in low risk investments? No. I have to say this. You might disagree with me. In real life, you might say like, no, I do not like risk. I'm always going to go low risk. But you're losing out on potential gain. That's what I'm saying if you do that. So we're going to say not appropriate, okay? Given that Bruce is still young, he should have most of his investments in a higher risk fund, in higher risk funds, sorry, in higher, get rid of that A in front of higher, just in higher risk funds. Okay, something like that. His portfolio has most funds in low risk investments. He should consider investing in higher risk funds such as the stock market. Stock market is like your classic high risk, high reward kind of thing. Okay? All right, that's 13. And I'm going to try a few questions that I did in the homework that I assigned. So I think it started on page 11. Let's go to 11. Is there anything in particular on page 11 that you want me to discuss? Anybody that would like me to try one question on there? Anything stands out? Tia, I'm gonna pick on you. Which one was the one you were asking me about? What page was it? 12C. Let's try that one there. I think Kamal, you also asked me about that one. Okay. The problem with this question is it actually starts on page 11. But I'm gonna do the whole thing. That way you don't have an excuse that I didn't do enough questions. Okay, so I'm gonna go back to 11, sorry, and we're gonna start right there with Samuel. All right, Samuel would like to purchase an ATV worth $3,000. So that's how much you kind of want to have in the future. How much would he need to deposit if the bank offers a 48-month GIC, that's 4 years. Okay, that's easy to convert. And with an interest rate of 3.25, I would go 3.25% right away. So turn that quarter into a decimal. So you got your interest rate there as well. And we are in simple interest territory. How do we know we're in simple interest territory? Because there's no mention of compounding. Once you start hearing compounding periods, then it's game over. That's no longer simple interest, okay? All right, so here time is 4 years. Interest rate is that. Principal we're asking how much will need to be deposited, so that's principal is basically my question mark. And interest, I also don't know how much interest needs to be earned. Don't know the principal, I don't know interest. So I did say that if you don't have two things, then you have to use this formula, right? Use A is equal to P1 plus RT. Okay. And A is how much you want to have in the future. So this amount here, if you want to circle it, this is A. Okay, that's the future value. That's A. So now we know that. So 3,000 gets substituted into this. Principal is what I want. 1 plus interest rate is this. And time is 4. Close it like that. So that's 3,000 is equal to, I don't have the key in front of me right now, so I'm just going to do this. 0.0325 times 4. That's 0.13 plus 1. That's 113. So this is P times 1.13 essentially. So I just need to divide by 1.13. Cancel that out. So it's 3,000 divided by 1.13. And so essentially, you figure out that this is 2,654.87. Okay, that's how much you need to put in to achieve your goals. Yeah, I got it right. So that's a good sign. We're starting off good here. What is the rate of return of the investment? Rate of return of the investment. So you have to do a little bit of make sure you write this down if you're not sure what the rate of return is. In this particular case, it's interest earned over principal. That's how much you've put in, times 100. So how much interest will have been earned here? This is where you have to be careful. Interest earned. You're gonna, if you think about it, I need to go back up, sorry. You were gonna go from this amount invested, it's gonna grow to 3,000. So that is how much you've earned, that difference. So I'm gonna use that. Interest is going to be the future value minus the principal. Okay? So this is something it's always true on the side. So if you have enough information, you can use this to help you out. So this is 3,000 minus 2654.87. Isn't interest PRT, Mr. Erickson? Yes, also true. Okay, it is true. But if you have the two, you can just subtract them. So there I have 345.13. So this is important, but not the final answer yet. Let me just bring this up so that people in the back can see this. That is interest earned. So we can go 345.13 divided by what you've put in, the principal, which in this case is the 2654 times 100. And if you do this, you get 13% exactly, because it's 12.9998. So in this case, it's 13% rounded to 2 decimals. Let's keep going. On page 12. At the end of the 48-month investment, Samuel does not buy the ATV, instead takes his $3,000, reinvests it into a 5-year GIC. Now I see why it's 9 years, come on. Because it was a 4-year and then another 5 years, so it's 9 years altogether. There's your interest rate, 5.12. How much money what do you have at the end of the 5 years? Completely, okay, like now you reset, you take your money, you earned money to get it to 3,000, do this again. Okay? So time is 5 years. Make sure it's in years, okay, guys, no matter what. If it's given to you in weeks, divide it by 52 to get your years, okay? Rate is 0.512. Do not round this one, okay? Principal, we're putting in 3,000, and therefore, interest is what I need to figure out. I just want to foreshadow what's happening here. What does it ask you? It says how much money would you have at the end of the 5 years. We're going to calculate interest, okay? But if we find the interest, then these two together will give you how much money you have altogether, okay? So interest is equal to PRT. That's 3,000 times 0.0512 times 5. You end up with $768. Okay? And so how much will you have at the end? That's A. A is always equal to P plus I, pi, right? So we have $3,000 plus 768. So that's where the 3,768 comes from in my key. That's how much you have altogether at the end of the 5 years now. Alternatively, it is okay to use, I'm going to say, or if you wanted to use this formula right off the get-go, you're okay to do so. Because if you use this formula, you're in fact going straight to that answer where you figure out the final amount after the 5 years. So this would be 3,000, 1 plus 0.0512 times 5. And this here gives you 1.256, right? If you multiply, then add 1. And then if you multiply those together, you're going to get 3768 even. So both ways of calculating works. Okay? But this one here that I just used must be used if you have two unknowns. Okay? If you have too many unknowns, then you have to use that one no matter what. Okay? So again, we started with 3,000 in this case, and we racked it up to 3768. So how would you find interest earned from this one? You would go this minus principal to get that, okay? What is the rate of return? After 9 years. Why is it? Because there was a 4-year plus a 5-year investment, okay? So that's why we have now a combined, we're looking at 9 years overall, okay? So, rate of return. Let's do the bottom part. How much money, how much of the 3768, my pencil is pointing to that one right there, how much of that money came from your pocket? This goes back to the very beginning. 3A, remember how we figured out principal, like this is how much money you had to invest? So that's what we copied down here, 2654.87. It didn't say anything that Samuel put more in here to beef it up even more and then put it away for another 5. It didn't say that at all. So this is what it is. How much interest did we earn already at the very beginning? The first 4 years gave me that much interest. how much interest did I earn in my 5-year investment just now? I'm pointing right at it, 768. I know my key is probably slightly differently, but it will give you the same, sorry, times 100. So let's add this up. That's 1,113.13 divided by 2654. 87 times 100. That is 41.93%. By the way, the rate of return could be 200, 300, 400, 500%. It can be anything. Unlike probability where 100% is our max, right? That's probability. You can grow your money. You can double, triple, quadruple it. You can keep going, right? So with money, there's no limit as to what your rate of return could be. Could there be a negative rate of return? Yes, unfortunately, yes. The world tells you that, right? Like you could lose money. You could lose money. And then it could be a negative, which means the top number here will be negative, okay? Yeah, that's all I have for now. Any other questions? You good? This was a GIC. Was there a GIC at one point? Yeah. Okay, pop quiz. What are good things about GICs? What is a good thing about a GIC? It's low risk, it's really safe. Okay? What's the downside of a GIC? What did you say, Yude? It's locked. Yes, it's locked. Okay? I'll tell you something. 2 years ago, if you locked in for a 5-year GIC, you got 5% interest. That's like unheard of. Like amount of savings, like interest that a bank would give you for saving money, 5%. So I had to sign. So my kids had 2 savings accounts for them, and I'm like, they're not going to touch it anyways. Even if they want to touch it, I'm not going to let them, right? So I took both of theirs, locked it in, right? So GIC, 5 years, sign, forget about it, right? Another downside is you can't keep contributing to it. Like it's locked. Like you can't put in, you can't take out. Like it's locked for 5 years. But you can keep putting money into that savings that you had, your general savings. You can keep putting money in there. 5 years are over. You can say, okay, I want to now take what I had in this savings, put it in there as well, and sign for another 5 years or 3 years or whatever. You know what I mean? So you can always play around with your investments. Okay, try things, ask questions, and so at the end of the day, if this course at least equips you with some term